right, let's get right into it. We're going to talk about something that's always kind of working in the background, quietly affecting your money, even when you're not really paying attention. We're talking about inflation, and specifically what it means for your investments. I mean, you've definitely heard this word everywhere, right? It's all over the news, prices are going up, the cost of living is climbing. It just feels like it's a constant conversation. But what does it actually mean? Because really, when you get past all the headlines, this is a concept that directly hits your wallet, your savings, your entire financial future. And see, that's the crucial part. This isn't just about us understanding some big, scary problem. It's about figuring out a strategy. So, let's do it. Okay, first things first. We need to be on the same page. What exactly are we talking about when we say inflation? So, in the simplest terms you can think of, inflation is just the speed at which prices for pretty much everything are going up. From your morning coffee to the gas in your car, it all starts to cost a little bit more over time. And this, right here, this is the perfect way to think about it. It's the real-world effect. Your money literally loses its purchasing power. That same $20 bill that's in your pocket today, well, it's not going to stretch nearly as far as it did last year. That, my friends, is inflation in a nutshell. Okay, so let's build the bridge from our wallet to the stock market. How does this rise in prices start to ripple through the world of stocks? Well, it happens in a few really key ways. The very first, most direct impact is on the businesses themselves. All of a sudden, the cost of just keeping the lights on and doing business starts to creep up. Just think about it for a second. The raw materials a company needs to make its products, the fuel for its delivery trucks, the wages it pays its employees, every single one of those costs goes up. And if a company can't pass all those higher costs on to you, the customer, then their profits can take a serious hit. All right, next up, let's look at the other side of that coin, the customer. And that means you, and that means me. It's simple math, right? When more and more of our paychecks are going towards the absolute essentials, groceries, electricity, rent, there's just less money left over for all the other stuff, the fun stuff, the new gadgets, the vacations, all the nice-to-haves. And that dip in demand can really hurt the sales of companies in those non-essential sectors. Now this next one, this is a big one. This is the big reaction from the people whose job it is to manage the economy. We're talking about the central banks. So you have to wonder, right? Why on earth, when prices are already high, would a central bank deliberately make it more expensive to borrow money? I mean, it seems totally counterintuitive, doesn't it? Well, their main goal is to pump the brakes on the economy. By raising interest rates, they make it more expensive for companies to borrow money to grow, and for you and me to take out loans. This slows down spending across the board, which eventually helps get inflation back under control. But, and this is a big but, in the stock market, higher rates can put a ton of downward pressure on stock prices, especially for those high-flying growth companies that totally rely on borrowing to fuel their expansion. And finally, there's the psychological part of all this. Inflation basically injects a huge dose of unpredictability into the entire system. If there's one thing the market absolutely hates, it's uncertainty. Investors get nervous. They have no idea how high costs will go, how people are going to react, or what the central banks are going to do next. And that caution, it almost always leads to more volatility, bigger, sharper swings up and down in the market. Okay, so I know that all sounds a little bit gloomy, but here's where we pivot. Because challenges in the market, they almost always create opportunities for investors who are paying attention. So this is the million-dollar question on every investor's mind. With all of these headwinds, should I just get out of the market completely? And the answer is a very clear not necessarily. In fact, you could argue that just sitting on cash is even riskier because you're literally guaranteeing that your money loses its value every single day. The right stocks can actually be one of your best defenses against inflation. Now, this slide is absolutely key because it shows us where those opportunities might be hiding. Certain companies can actually do really well. We're talking about businesses that have what's called pricing power. Brands that are so strong or products that are so unique, they can raise their prices without losing all their customers. We're also looking at essential sectors. Think about energy companies. We all still need to fuel our cars. Or consumer staples, because no matter how high prices get, we still need to buy toilet paper and toothpaste. So, all of this brings us to the most important part of our chat today. We've understood the problem, we've spotted the opportunity. Now what do you actually do about it? So here it is, your investor playbook for an inflationary world. Let's just walk through it real quick. Number 1, stay invested. Seriously, the biggest mistake people make is panicking and selling everything. 2. Focus on quality. Remember those strong companies with pricing power we just talked about? Yep, those. 3. Diversify. You've heard it a million times, but don't put all your eggs in one basket. 4. Look at dividend stocks. They can provide a really valuable stream of income when prices are rising. 5. And this is so important, think long-term. Just ignore the day-to-day noise. And finally, number 6. Be consistent. If you have a regular investing plan, stick with it. Those scary market dips, they're actually buying opportunities in disguise. Okay, let's zoom out one last time and put all these pieces together. It's really all about matching your strategy to the challenge at hand. And this right here just illustrates the entire game plan perfectly. For every single challenge that inflation throws at you, rising costs, nervous consumers, higher interest rates, all that uncertainty, there is a strategic response. You're not just a passive victim of the economy, you're an active participant with a solid plan. And I really just want to leave you with this final thought. Look, inflation isn't new, and it's not going to last forever. It's just a part of the economic cycle. The key isn't to be afraid of it, it's to understand it. Because investors who panic are just reacting to the headlines. But investors who adapt, they're driven by a strategy. And over the long term, believe me, that adaptability is what makes all the difference in the world.